At a certain level of real estate quality, the asset itself stops being the main driver of performance. That sounds counterintuitive. Two properties, similar quality, similar price, sometimes only a few streets apart. 20 years later, the performance gap is not small, it is structural. And yet most investors struggle to explain why. The default answer is usually simple: location. But that answer only shifts the question, because it doesn't explain what actually creates a better location in the first place. Locations don't improve themselves, people improve them. And over long periods of time, that improvement is not random. It is driven by ownership behavior. Because what compounds in real estate is not just capital, it is decisions. Decisions on maintenance, reinvestment, redevelopment, planning, supply, preservation. Individually, these decisions seem small, but collectively, they shape the trajectory of entire micro markets. This is where micro-location begins. Not a city, not a district, not even the neighborhood, but a small ecosystem of ownership behavior. Most investors evaluate property through two lenses: the asset itself and the location. Both matter, but there is a third layer that often becomes more important than either: the ownership ecosystem surrounding the asset. Who owns nearby buildings? Are they long-term holders or short-term investors? Do they reinvest or extract value? Is development coordinated or fragmented? Are incentives aligned or misaligned? These questions rarely appear in traditional analysis, but over long time horizons, they often determine outcomes more than the property itself. Because property does not evolve in isolation, it evolves inside systems. Imagine two apartments, both worth 2 million euros, both in prime, desirable areas, both in excellent condition, both purchased by experienced investors. On paper, there is very little separating them. Now, widen the frame. The first sits inside a tightly held environment. Long-term ownership dominates, buildings are consistently maintained, development is controlled, future supply remains limited, standards are actively preserved. The second sits in a more fragmented environment. Ownership is mixed, standards vary, reinvestment is inconsistent, planning pressure is higher, future supply is less predictable. Today, they appear almost identical, but over time, those surrounding conditions begin to compound. Slowly at first, then decisively, and eventually the performance gap becomes clear. Not because the properties changed, but because the system around them did. This is where many investors misread what they are actually buying. They believe they are buying an asset. In reality, they are entering a network of future decisions. Every renovation, every redevelopment, every planning decision, every neglected building, every new supply decision. These accumulate into the environment your property sits inside. And that environment becomes part of the investment itself. This effect becomes stronger as you move up the quality spectrum. In secondary markets, value creation is often direct. You improve the property, you reposition it, you create upside through change. But in prime markets, most assets are already high quality. Many are exceptional. So differences become subtle. And when differences become subtle, the surrounding ecosystem becomes dominant. This is why one street consistently outperforms another nearby. Why certain micro locations preserve value for decades. and why some areas become more exclusive over time rather than less. It is rarely accidental. It is structural. When evaluating a property, most investors ask, what am I buying? A more revealing question is, who am I buying next to? Who owns the surrounding assets? What are the incentives? Do they preserve scarcity or dilute it? Do they reinvest or extract value? Do they stabilize or fragment the environment? Because those decisions made by others shape the performance of your investment as much as your own decision does. This sits within a wider framework exploring how market structure shapes long-term property performance in the Algarve. In the previous episode, we looked at why identical golden triangle homes can produce completely different returns, and how rental-driven versus owner-weighted markets create fundamentally different investment outcomes. This builds on that idea by moving one level deeper, because even within those systems, performance is ultimately shaped at the more granular level, the micro location, and the ownership ecosystem surrounding it. And in the next episode, we apply this framework directly to Vilamoura in 2026, and whether it still represents a rational investment under these structural conditions. Because at a certain point, the question stops being whether a market is attractive and becomes something more uncomfortable. Not, is Vilamoura a good investment, but is it still behaving like the same type of market investors think it is?